Evening, everyone. A very warm welcome to all our distinguished guests, banking leaders, industry experts, and valued partners to IVR Connect 2026, an initiative by Infomerics Valuations and Ratings Limited that brings together stakeholders from across the financial ecosystem to exchange perspectives on the evolving economic and financial landscape. To formally commence the evening, I would like to invite Mr. Shubham Jain, our Group CEO, Infomerics Group, to deliver the welcome address. A warm round of applause for Mr. Shubham Jain.
Good evening, ladies and gentlemen. On behalf of Infomerics Valuation and Ratings Limited, it gives me immense pleasure to welcome you all to IVR Connect 2026, which is a new initiative by the group. I extend a warm welcome to our distinguished keynote speaker, respected panelists, esteemed banking leaders, valued clients, and my dear colleagues. We are truly honored by your presence here. Today, we are meeting at a particularly significant juncture for the global and Indian economy. Across the world, businesses and financial institutions continue to navigate an environment shaped by deepening geopolitical crises, from conflicts in West Asia disrupting energy supplies and pushing crude oil sharply at the higher levels, to evolving US trade and tariff policies that are reshaping global supply chains and export competitiveness. Especially for India, US reciprocal tariffs have introduced real headwinds for the key export sectors, while a more volatile rupee, reflecting both global risk sentiment and elevated import costs, has added another layer of complexity for businesses and financial institutions. At the same time, central banks across the world, including the RBI, continue to balance the twin objectives of supporting growth while maintaining price stability. Just days ago, the RBI's Monetary Policy Committee held the repo rate at 5.25% with a neutral stance, a measured response in an environment where inflation projections for FY27 have been revised upwards by 50 basis points, while GDP growth has been projected downwards by 30 basis points. Movements in interest rate, foreign exchange markets, capital flows, and commodity prices continue to influence business decisions and investment sentiments across the world. Nevertheless, Indian economy continues to demonstrate remarkable resilience, as shown by Q4 GDP growth numbers. Strong domestic demand, sustained infrastructure investments, a banking sector with historically low NPA levels, growing digital adoption, and the continued strength of our corporate sector provide genuine reasons for confidence and optimism. Beyond these macroeconomic developments, we are also witnessing a profound transformation driven by technology and innovation. Artificial intelligence, advanced analytics, and digital technologies are reshaping the way businesses operate, assess risk, improve productivity, and make investment decisions. In such a dynamic environment, the role of institutions across the financial ecosystem becomes increasingly important. Timely credit assessment, prudent risk management, and transparent market intelligence are critical to support sustainable economic growth. At Infomerics, we are committed to contributing to this ecosystem through credible ratings, independent research, and insightful analysis. We believe that informed dialogue and collaboration are essential for navigating an increasingly complex economic landscape. Today, we have an engaging evening ahead with a keynote speaker address by Mr. Nagaraju, insightful presentation based on primary data collected by Infomerics, a distinguished panel of seasoned lenders and industry leaders deliberating on today's theme, followed by a networking dinner. I am confident that today's deliberations will generate valuable insights and meaningful outcomes. I thank each one of you for taking the time to be with us and for your continued trust and association with Infomerics. I wish you all a productive and engaging evening. Thank you.
Thank you, sir, for your warm welcome and opening remarks. Your words have set the perfect tone for an evening of insightful discussions and meaningful engagement. To begin the formal proceedings of IVR Connect 2026, it is now my privilege to invite our keynote speaker for the evening. We are honored to have with us Mr. M. Nagaraju. Mr. Nagaraju is a 1993 batch IS officer who took charge as Secretary, Department of Financial Services, Ministry of Finance on August 2024 and continued working on various financial initiatives till his retirement in May 2026. He joined the Ministry of Coal as Joint Secretary in January 2020 and was promoted to Additional Secretary in November 2020. He earlier served in Department of Economics Affairs as Director in Japan, North America, and World Bank divisions, and then as an advisor to the Executive Director at the World Bank in Washington. He is a University of Hyderabad alumnus and has been a visiting fellow at the University of Pennsylvania and a visiting research scholar at Stonehill College. He closely follows emerging technology developments and their implications for the financial ecosystem, with a particular interest in risk management. Please join me in extending a warm welcome to Mr. Nagaraju as he delivers the keynote address. We also request Mr. Suraj Pratap Malik, our whole-time director, Infomerics, to welcome Mr. Nagaraju.
Good evening, ladies and gentlemen. Ms. Suraj Malik and Mr. Ravindra Joshi and entire team of Infomerics. I think many of you know that she already announced that I superannuated last week, and this is my first public speaking engagement. And I think some of you know I generally give a prepared speech so that I don't want to make mistakes. And then I was quoted wrongly by the media. But that now, that caution is not there with me now. Now that I'm outside the government, I can speak my mind. And I'll be delighted if I'm quoted wrong also. I'm going to touch the 3 points I wanted to talk. One is, of course, the macro fundamentals, how we are doing in the economy, how the country is doing. The second one is what is our credit cycle, how our banking system is doing. Third one is what is our strategic challenges that the country is currently is facing, of course, and likely to face in foreseeable future. It's not today. We are all, I think, many of you are very distinguished professionals in your own domain. I am aware of your expertise. So indulge me in if I make my own personal comments on this. The GDP growth we estimated in the budget 7.4 estimated. In the last MPC meeting, it was revised by the RBI anywhere between 6.6 to 7.2%. I also tend to agree. I have been seeing in the numbers that we will be around that percentage only, not more than that. Now, we are in the month of June now. We have again another 6 months left. So if the cloud over us, Hormuz cloud, is not lifted, I think we are likely to stay around these broad numbers that were given. Now, while we mentioned, I think all of you know, CAD, 1% of GDP. And again, because of the additional expenditure on two fronts. One is, of course, the fuel, the other is fertilizers. The CAD is likely to increase further. And we don't have hard numbers now, but likely to increase. That's one broad macro fundamentals. While we would have, in fact, the budget announced our deficit is likely to stay around 4.3 because last year, the budget, the estimates of 4.4, it was contained. Same thing we maintained. Whatever the promise was made in the budget, that was kept by the government, 4.4. And this year, we wanted to bring it, the government wanted to bring it to 4.3, but may not be because of the uncertainty that is prevailing. Now, while despite that, even if let's say increases the fiscal deficit, still it is a significant signal to the world at large, the prudent fiscal management by the government. Even during the COVID times, I think India is known for highly professionally managed fiscal management in the country, and we still get good returns from that management. And this time also, despite all kinds of things, we are still, I think, countries we are managing that. The external factors I have mentioned, which are going to impact, I think all of us are aware. Two significant factors. I'm only talking about the outcome. The one is the energy. The second one is fertilizers. Fertilizers, the budgeted amount was 1.71 lakh crore, and it's likely to be almost doubled. And while I think many of you may not be aware, the government has actually been diversifying the supply side of fertilizers from the earlier concentrated in the Middle East. Now, a lot of countries, bilateral agreements are being talked, being negotiated, so that the fertilizers shortage is not there in the country. That's very important for us because I think all of you are aware, any significant negative impact on the agricultural production will have a lot of impact in the rural areas, both consumption as well as the employment. First thing is employment and consumption both will be negatively impacted, and then still large number of people depend on agriculture. So it's a very significant risk for the country as such. Therefore, the government is actually making a lot of efforts to ensure the fertilizer is diversified and supply chains are secured. The second one is, of course, oil. And oil, I think all of us know, I think oil OMCs have been, I see somebody is here, and OMCs have been incurring a good amount of the cost, and some cost has been passed on, and I think some other costs, I think the full cost has to be passed on. And otherwise, they are going to there are only two ways, whether they are going to incur losses or the government has to provide the financial support to the OMCs to ensure that they are not into the thing. So I think there's still some wiggle room is there with the government for some time to think about it. And but these two remains serious external risk, and because the Hormuz is still, I think, everyday news for all of us. Everybody is keenly following. But one question that is in the analysts was raised: why despite the more or less complete blockade at Hormuz, still the oil prices have not gone beyond 110, 120, 115. But I think one is India is one country, I think all of us know, India is one country that is most impacted negatively by Hormuz. And we source large number of energy supplies from the Middle East, and we continue to source also, because we are one country without much natural these minerals. We don't have any of this. We have little, but that's not enough given the size and consumption pattern of our country. Now, second thing I would like to tell you is the incredible success story of the scheduled commercial banks. I think last year, I think some of you may be aware, last year we had a growth of 15.91. This is the highest ever in the many years. 15.91 credit growth last year. Agriculture growth was 15.7% compared to 10.4% of previous year. And industries credit is 15% compared to 8.2% of previous year, 24-25. And services, 19% from 12%. These are all broad indicators that the credit is very robust, the cycle is good. 24-25 we did well, but 25-26 last year, by March end, we did incredible numbers as far as the banking sector is concerned. The total aggregate credit outstanding in March 31st, it was 212.9 lakh crore. That was almost 30 lakh crore higher than 24-25. 30 lakh crore. Just last year, additional credit we have actually disbursed the country's banking system. That's a huge amount going into the cycle. This year, my expectations is that anywhere will be between 37 lakh to 40 lakh additional credit will be flowing into the economic system, because we had, I think all of you know, public sector banks made almost 2 lakh crore profits last year. And the private sector also made good profits. I was calculating, we give about 20% of the profits as dividends. And then we'll be left with anywhere between around 2 lakh crores, private sector, public sector together. And 2 lakh crores, generally, the norm is in the banking at 11 to 14 times of the capital that is with the bank, we can actually lend. So it almost comes about anywhere between 37 to 40 lakh crore. Additional credit is likely to flow into the economy, which is a great thing for us. Now, coming to the, so what are the challenges? Of course, many of you are aware, but I'm at the cost of repetition. I'm going to tell you. So our strategic challenges are, the first foremost, as Secretary of Financial Services, I kept talking about it, we have to attract more capital. That remains number one challenge for us. We have to attract good capital, we have to attract patient capital, we have to attract strategic capital for our economy. On that, there is no second thought at all. If there are 3-4 challenges, actually it remains capital, capital, capital. At this stage of development, economic development of the country, what we require is capital, either from the domestic side or from external side. More capital is required. For that, there are several challenges. Within that, I'm not going to touch them. You have capital market, you have to do a lot of things. You have to do a lot of financial sector reforms we have to do. We have to do ease of doing business. We have to do a lot of regulations, revamping. We did last year, we attempted something. Now we ask all our regulators to form a committee, external committee, which we did, starting RBI, IRDA, PFRDA, and SEBI, who will review the existing regulations and ensure that they are consistent with the current requirements of doing business. I hope that will take time, but we need to continuously do this. And then the second one, the strategic challenge is energy. Energy is going to be the key. I think while capital is important, energy is fundamental. Without energy security, we are not going to see the country progress. We have, since I worked in the coal ministry, so I know a little bit of energy sector. And I also happened to be a power secretary for some time in my state. Still we import coking coal, I think all of us know. We import LNG, we import petroleum, we import crude. In fact, we import all shades of energy. There's nothing that we don't import. In fact, till 3 years ago, we import the wafers. We don't have, now because of the PLI, wafers production will start in the country. And the infrastructure we built, the RE infrastructure is actually built on imported materials. Many of us don't know. China dominates about 98% of the world in the wafer production. And we have not done, only in the last 3 years, I think we have taken measures, PLI, and we are going to have that. Now, that's why the country, China, is having stranglehold on all others, including on India. Now, if we want to become a developed country by 2047, energy, we need to have, our GDP need to grow anywhere between 11 to 12%, but which is very tall order, given our challenges that we face. But energy also, there is a linkage between energy growth and the GDP growth. Energy also we have to grow. Electrification of a lot of activities that I undertake, and the security of that electrification, stability of that is also very important that we need to do. Therefore, the recent measures, in fact, in one sense, I actually feel that the Hormuz has opened the eyes of large number of Indians about the potential risk that we face as a country going forward. And we need to take steps for that. We need to insulate. We need to ensure, we need to have security of energy supplies. We need to do that. You know, one of the byproducts that we do from the coal is coal gasification, okay? Some of you may be knowing. Coal gasification produces a lot of chemicals. In fact, many chemicals that we talk about, very high-end chemicals, specialty chemicals we call, they are produced. We never had only one plant we had in the country. That was Jindal's. Others we don't have. In fact, China in the last 15 years, West has tried, Germany tried one, and then South Africa has one gasification plant called Sasol. As US done a lot of research in 1930s, 40s, and then left it. Whereas China has mastered the technology. We have more than 100 plants which are built last 15 years. When we want to do coal gasification technology import, we face, of course, we don't have technology. China has monopolized the entire technology. They purchase all Western technologies and kept themselves. And then we don't have the manpower expertise. Both we don't have. Now, thanks again to the coal ministry, but the last 2 years, in fact, of course, the one is the first we did when I was the additional secretary there, coal gasification scheme. Now, recently, the government has again provided a higher allocation for coal gasification, about I think about 28,000 crore. Again, that is also, all those chemicals, we are dependent. People don't know this. All those chemicals, we are dependent. And we are importing from large number of countries. And fortunately, I think we have taken the steps. That security also will be ensured. The third point I have on the strategic challenges we faced is tariff wars. I think Trump is going to be there for another 2.5 years, and we have to live with that. But then it comes with the familiar territory, uncertainty, and this tariff wars. How do we negotiate tariff wars? And it's not only important that we negotiate fairly. I never, in the international trade, the fundamental principle is international trade should never be advantageous to one country. It's not zero-sum game. It has to be, both have to be benefited. Both have to see the negotiated trade settlement is beneficial to both equally. And we need to have fair, balanced trade agreements so that the trade wars that we are now, I remember when I was a student in the university, I think many of you are there, I think at that point of time, we have this GATT negotiations going on. And there are people who wanted WTO, people who don't want WTO, and going on. Now that system, which are good or bad, WTO was there. It held the international trade system in place. But now in the last 2 years, it doesn't exist anymore at all. Each country is to its own. Everybody is looking after themselves. And I think it's, now of course we also look after ourselves. But thinking that the international fair trading system will be existing for the benefit of humanity or for the world progress or world growth, I don't think is going to be the case. Everybody has blocks, trade blocks. Everybody has bilateral blocks, and everybody has strategic blocks and different parts. So we need to choose our trade wars and how do we wage them, how do we negotiate them very carefully. I'm aware that our Commerce Ministry guys and the MEA, they have been doing that. I think that is one important element that will be going to be there. The fourth point, which is I kept talking for some time, I think the last 1 year, the private sector has to step up its investment. I think I have noticed very closely, I have got the numbers from their investment record in the last 5 years. It's not very good. I don't want to tell about that, but it's not very good. Many of these companies are with the healthy balance sheets because of our the very healthy banking system. Our banking system NPAs are almost now less than 4%, less than 0.4%. In fact, one of my bank, the public sector bank, Bank of Maharashtra, is actually NPA, net NPA is 0 last quarter. And but many of these big private sector companies, except a couple of them, not investing much. And as long as the public sector dominates the investment in the country, I think we will not be having that much kind of efficiencies. Private sector has to borrow. Private sector has to invest both their profits and then the debt they raise. That they have to do that. Now, the fifth point I have, the strategic challenges, is the manufacturing capacity. We have so many MSMEs. We all say that MSME is the backbone, is the key, provides a lot of employment, and more than 60% of our non-merchandise exports from the MSMEs, everything. But our productivity is very, very low. And across some sectors, some areas, MSME productivity actually comparable with global standards. But generally, our productivity is very low. We need to have that integrity in work, both for workers as well as for management, for mass production. Somebody who went recently to China told me, in fact, this person went and then spent about 10 days, something like that. He never went to China. And he came back and told me, he said, first of all, what China is doing is incredible. We Indians don't understand what they are doing actually. Many of us talk in the air. They are actually a mercantile economy. Their shop floors are bigger than our football grounds. Anything you talk, and starting from toy shops to television screen to furniture manufacturing, anything. He says the factories are big, huge factories. And that kind of efficiency we will not be achieving. In fact, not even America or any European country has that capacity and the skill set. And everybody is underestimating China's capacity to mass produce. I don't expect, China took a lot of time, but given their system, they are able to do that, but it may not be happening to us. But we can also try. In fact, there are some sectors we do very well. And manufacturing also we have to focus. I remember as a director in the finance ministry almost 20 years ago, we always used to say that manufacturing is a key. We had a lot of agreements with a lot of countries on inviting them to provide us how we can actually excel in the manufacturing. We are still doing it after 20 years also. I think this is time to step up on mass production of manufacturing capacity. The last one, I'm only mentioning the sixth one is supply chain disruptions. This is going to be there. Now, given our neighborhood, I'm not talking the political risk that are involved. I'm only looking at from the economic perspective. Given our neighborhood, we will face volatility, both political and economic, for a long time to come. And supply chain disruptions is a certainty. And we have to work around that. How do we insulate our key supply chains are protected, secured through multiple channels? It's not one country we can depend. You can have to depend on multiple countries. For the same product, different countries. And then ensure both private sector is actually playing very important role to ensure the country is progressing. Now this is what the Infomerics has mentioned uncertain times. In fact, I actually feel I will draw attention to one of the earliest Greek philosopher, Heraclitus. I think all of you are aware. His philosophy is everything is in motion and flux. And in fact, change is constant. Change is constant. Everything is in motion. Everything is transformation going through, and nothing is permanent. And this famous saying, I think many of us heard, you cannot step twice into the same river twice. That applies to our times also. So my sense is uncertainty is going to be new normal. We should not be taken by surprise that there is uncertainty. Uncertainty is going to be there. That is going to be new normal. And therefore, we have to hedge that into our risk matrix, whatever we are doing, and then ensure that the country is progressing and businesses are doing well. That's how we have to navigate. There's nothing normal now, actually. In the last 4 or 5 years, there's nothing normal. Every year there is something new. And this uncertainty will continue to be there, both for the country as well as for the world, and we need to navigate that successfully. So with these remarks, I thank Infomerics for inviting me, and to all of you, all the distinguished audience, for giving me very patient hearing. Thank you so much.
Thank you, sir, for sharing your valuable insights and perspectives. Your thoughts have provided an excellent context for the discussions that will follow this evening. We now move on to our next segment. It is my pleasure to invite Mr. Vipin Jindal, Director, Ratings, Infomerics Valuations and Ratings Limited, to present his views on the evolving credit landscape, emerging opportunities, and learnings from the Infomerics portfolio. Ladies and gentlemen, please welcome Mr. Vipin Jindal.
Just 1 second. It's not. Good evening, everybody. A warm welcome to all the dignitaries present here. I am Vipin Jindal. I'll be taking you through a brief overview of the Indian economy and study of Infomerics on key sectors. So I'll begin with a brief introduction about the Infomerics Group. Established in 2015, Infomerics Ratings is a SEBI-registered and RBI-accredited credit rating agency. Since 2015, we have developed a strong expertise spanning MSMEs, large corporates, banks, NBFCs, and different sectors. So, moving on to the Infomerics umbrella, apart from Infomerics Ratings, we also have other two companies. One is Infomerics Analytics, which is providing a comprehensive advisory services in credit ratings, risk advisory, ESG. We also have an international footprint, having a subsidiary based out of Nepal. So we carry out the credit ratings in Nepal. In terms of our capabilities, we are backed by a strong team of experienced analysts, robust in-house methodologies, and deep sectoral expertise, so which enables us to deliver consistent and forward-looking credit opinions. One of the key differentiator for Infomerics is that we have an external rating committee. So that not only ensures that ratings remain credible and transparent, but they are also aligned with the highest standards of governance and accountability. Now, let us take a close look at the key economics insights. So, post-COVID, our economy has been witnessing a sharp growth. So, it has ranged between 7 to 9%. But due to the headwinds in the international sector, the West Asia war, our economy has been facing certain challenges. The gross fiscal deficit, which has been coming down and has been hovering around 4.4%. So that is also uncertain and it may go up going forward. So why I'm saying that? Because India's macroeconomic outlook is highly sensitive to the crude oil prices and due to heavy import dependence of around 85 to 90%. So if we see, because of this uncertain global environment, the revenue collection may fall short of budget estimates, and the combined impact of higher expenditure in the crude and lower revenues could weaken GDP going forward. So it is pertinent to note that RBI has also lowered its FY 2027 GDP forecast from to 6.6% from 6.9% earlier. So if the conflict persists beyond 3 to 4 quarters, so this GDP, the fiscal deficit could also exceed the budget estimates. Now let us see how this crisis impacts the economy through a clear transmission channel. Higher crude prices increases freight and logistic costs, which pushes up wholesale price inflation, and ultimately it leads to the retail inflation. So WPI has moved up to 8.3%, and our CPI has also risen to 3.4% recently. So on the external front, the rupee is also facing pressure, weakening beyond 95 rupees per dollar, driven by higher import bills and capital outflows. So inflation and currency volatility remains key risk going forward. So despite global risk, India's key strength lies in its investment-driven growth model. So if we see, the capex of the central government has been increasing, and it has increased 9% YOY to 12.22 lakh crore. State capex remain key contributors to public investment, supported by central transfers and interest-free capex loans. Private capex has also been rising, and it has increased from rupees 5.9 lakh crore in FY 2022 to close to rupees 10.7 lakh crores estimated in FY 2027. So this strong public-private investment cycle is helping to offset external shocks and supports India's medium-term growth outlook. Now moving on to the mid-sized EPC construction players, Infomerics has carried out a study of mid-sized construction EPC players. So we have carried out this study of 100 mid-sized EPC players having a turnover in the range of 200 to 5,000 crores, having a median turnover of rupees 500 crores. The aggregate order book of these companies stands at around 2 lakh crores, which provides a healthy multi-year revenue pipeline and strong execution visibility. So if we see, out of the estimated 2 lakh crore order book, 70,000 is estimated to be done in FY 2026, another 82,676 crore in FY 2027, and balance 47,000 odd crores in FY 2028. If we see the data which we have studied, the turnover is expected to increase from rupees 40,000 crores in FY 2023 to close to 82,000 crores by FY 2027, implying a staggering growth of 20% on a CAGR basis. Infomerics expects that this growth to be driven by continued focus by the government on infrastructure development, particularly in roads, railways, water supply, and urban infrastructure. Now moving on to the profitability of the sample studied. The profitability for the sample has also witnessed an improvement from 12% odd in FY 2023 to 14% in FY 2027. So this improvement in the profitability is on account of better project mix and rising economies of scale. In terms of credit profile also, Infomerics expects continued strengthening. The sample study shows that the leverage levels are improving, the balance sheets are strengthening across the sector. However, in the medium term, if we see, the sector faces certain key challenges. Because of this ongoing West Asia conflict, there has been surge in the raw material prices. So if we see the key raw material for the EPC sector, the broad-based steel and even the bitumen, so they have shown a significant increase in the raw material prices. Having said that, the short term, the sector may face some headwinds, but Infomerics believes that the EPC sector will continue to benefit from the strong revenue visibility and improving financial profile. Another important monitorable in the EPC construction segment entity is that the availability of the non-fund based limits. So the EPC player used to rely on non-fund based limits. So now there has been growing acceptance of the surety bond by the insurance companies. So this will result in some release and more acceptability of the surety bonds by the insurance companies. So the companies may rely less on the banking sector. Now moving on to the renewable energy sector. The renewable energy sector continues to play a central role in India's long-term energy transition and sustainability objectives. So Infomerics has estimated that the electricity demand is expected to grow close to 4% in FY 2027. This growth is driven by the overall economic growth, rising cooling demand, and more penetration of electric vehicles across the country. The generation mix has seen a significant move towards renewables. Renewable share has increased to 26% in FY 2026, and it is expected to move up to 29%. The majority of this renewable has been through solar. Solar, we have seen that the capacity addition has been 44 gigawatt in FY 2026, and it is expected to increase to 40 gigawatt in FY 2027. So, despite these strong growth drivers, the sector faces certain key structural and operational challenges. One of the key challenge for the renewable is the battery energy storage systems. So if we see by the total BES capacity is 236 gigawatt planned, but out of that only 0.2% is operational. And apart from this, the pump storage capacity, that is 5 gigawatt only installed, with 81 gigawatt under pipeline. Now moving on to the overall health of the power sector. The power sector used to face AT&C losses to the tune of 23% in FY 2020, FY 17. It has come down sharply because of the operational improvement. And going forward, FY 2027, the AT&C losses are expected to come down to single digit levels. So this has resulted in the ACS and the ARR gap has narrowed down to close to 0. So one of the key important thing in the renewables in the power sector has been the draft national electricity policy, so which has been positive for the renewables, because the policy says that the sector is transitioning towards a more competitive, market-driven structure and cost-effective tariffs, and parallelly lower cost subsidies. So rapid growth in renewables is also expected to be supported by storage. If we see the power sector investment required, so these are staggering around rupees 50 lakh crore by FY 2032 and rupees 200 lakh crores by FY 2047. So from the renewable sector outlook of Infomerics remain stable, supported by strong policy backing and healthy plant load factors and improving balance sheets. So thank you very much. And the question and answer will be taken up after the panel discussion. Thanks a lot.
Thank you, Mr. Jindal, for that insightful presentation and for sharing your perspectives on the evolving credit and financial landscape. To deliberate on these themes, we have with us an eminent panel of leaders representing some of India's most respected institutions. May I now request Mr. Rohit Inamdar, our CRO, our moderator for the session, to kindly join us on the stage, please. Welcome our distinguished panelists for the evening. Mr. Ashok Sharma, Deputy Managing Director, Chief Credit Officer, and Chief Sustainability Officer, State Bank of India. A banking veteran with over 35 years of experience, currently he leads SBI's credit and ESG agenda and contributes actively to regulatory and policy level discussions impacting the industry. Please, sir, may I please request you to come on the stage. Ms. Nalini Malhotra, Executive Director, GAIL India Limited, with over 3 decades of experience in India's natural gas sector. She has led key functions across corporate treasury, banking, commodity hedging, and finance. She currently heads GAIL's finance department and plays a pivotal role in managing the company's treasury, forex, and strategic financial operations. Mr. Anirudh Banerjee, Chief General Manager, Finance and Accounts, and Head of Treasury and Corporate Budget, ONGC Limited. Mr. Banerjee brings nearly 30 years of diverse experience in finance, treasury, strategic partnerships, and policy across the energy sector. Ms. Aditi Singh, Chief Strategy Officer, Saturn Credit Care Network Limited, with over 18 years of experience across investment banking, private equity, and financial services. She has been instrumental in driving strategic growth, investor engagement, and sustainable finance initiatives across the sector. Ladies and gentlemen, please welcome them with a round of applause.
Good evening, everyone. Thank you for coming all the way for this wonderful gathering. We will try to get maximum out of this panel. So I have prepared some questions for the panel, which we will go through. There are 4 rounds of questions thematically. First of all, let me just set the ball rolling. We are meeting at a time when credit risk is being shaped only, not only by balance sheets, leverage and cash flows, but also by forces which are outside the traditional credit model that we are used to, which are geopolitics, energy, prices, supply chains, climate events, interest rates, and so on. The keynote address did touch upon all of these factors very eloquently. So over the last few years, our markets have shown remarkable resilience. We saw in the keynote address that the bank asset quality has improved. Corporate leverage is relatively comfortable, which is what we saw in Vipin's presentation. And many sectors have repaired their balance sheets by now. Yet our external environment has become more volatile and less predictable. Change is the constant, is what we were told earlier. So the central question today for all of us is, how should lenders, large corporates, last mile borrowers think about credit risk when the next shock may not come from the borrower's own balance sheet, but it may come from energy markets, or it could come from geopolitics, or even climate events, or as something as simple as household inflation. So we have 4 important perspectives today. Ms. Nalini Malhotra, Executive Director of GAIL, will bring the gas and energy transition perspective. Mr. Aniruddha Banerjee, CGM, F&A and Head Treasury ONGC, will bring the oil, treasury and large corporate perspective into the discussion. Mr. Sharma, Chief Credit Officer and Chief Sustainability Officer, DMD, State Bank of India, will bring in the lender's perspective, much wanted lender's perspective. And Ms. Aditi Singh, who is the Chief Strategy Officer at Saturn Credit Care Network, will help us understand how uncertainty affects last mile borrowers. That's your forte. So the way I have structured this discussion is we'll have one common question for the entire panel, and towards the end we'll have one, again, common question for the entire panel as a wrap-up. And then in between we will have individual questions based on the theme that we are looking at. So starting with the very first question for the panel as such, let me begin with some broad question, which is, for the last 3 to 4 years, uncertainty has been a constant theme. If some event or the other has been happening every year or every half a year with recurring periodicity. So yet banks are reporting some of their stronger asset quality numbers in decades. Corporate leverage remains very modest. Rating upgrades have outpaced the rating downgrades in the last few years. So let me therefore deliberately ask a very provocative question. Is credit risk genuinely rising, or are we overstating the uncertainty narrative? I would like to start with the banker in the audience, on the panel, sorry. Sir, what is your take on current risk environment?
It's audible? Yeah. So I think before we understand the uncertainty narrative, let me just paint a picture of the credit markets. Uh, I look at two aspects of the credit markets. One is the composition of the Indian debt market, which I call stock. Second is the flow. So I just share you the story regarding the stock. So four broad components. One is the All India Scheduled Commercial Bank. Second, NBFC. Third, corporate bond market. Fourth, CP and CD. All of them put together 2026 number, 319 crores, 19 lakh crores. So let's say 320 lakh crores. Same number 2021, 5 year back, 167 lakh crore. So almost doubled. Look at the flow, 25-26. This is the data published by RBI. So the flow number is 43.12 lakh crore. This flow also includes the equity flow. Equity flow is around, total flow is 47.04 lakh crore. The equity flow is 3.92. So if I reduce the debt flow is 43.12. And this debt flow 43.12, the foreign debt component is 1.58, which means it is 3.6%. I go back to 21, the total resource flow is 16.02, the debt component is 1.81. If I reduce the net debt 14.21, and the foreign debt component is negative because there was no incremental debt during that year. I have analyzed this data from 2010, not burdening all of you with that data, but typically the foreign debt component remains in the range of 3 to 4%. So the bigger question is, do we depend upon the foreign debt? My understanding has been that we need the foreign equity. We need capital, certainly. So wherever you have seen, you see the renewable energy, you see the road sector, or whichever sectors are opened up, you have a lot of equity capital coming in, and that equity capital is leading to a lot of growth in the overall portfolio. Now, when you add this with the narrative of the West Asia, how does it look like? As former Secretary Mr. Nagaraju was mentioning, change is the constant. So this 21 was a COVID year, that pre-COVID. So we look at that way, that means we have been able to navigate all the issues that we face from time to time. And I am sure the issues that we are facing now relating to the West Asia, the transmission is still happening in the country. So energy prices, all prices are now, in last 1 month we have seen the prices getting increased. My sense is the markets as well as the companies would be able to navigate this, and of course this will have impact on the GDP and other numbers, but we would come out quite well, and maybe if after 6 months or 1 year the issue gets resolved, then we would be much more stronger. So I pause it here.
Mr. Banerjee, what is the treasury perspective?
Yeah. Yeah, first of all, good evening, ladies and gentlemen, and thank you, Infomerics, for inviting me and giving me an opportunity to present before you. It's an honor. Coming to your question, it's the fundamental credit versus perceived risk, what I could understand. I don't think this credit risk is being, universally overstated. Yes, a bit of, uncertainty get amplified during, this geopolitical scenario, or maybe some other black swan events. So, the narrative like credit risk in getting overstated or increasing may not be universally true. Talking about fundamentals, yes, in some cases like rising interest rate, maybe refinance pressures, weaker balance sheet for some of the sectors like maybe commercial real estate, maybe highly leveraged borrowers. In those cases, yes, I agree, fundamentally credit risk is deteriorating. In that sense, yes, there is a genuine risk Yeah. But on a balance of consideration, it's neither, there's credit risk is uniformly increasing, nor it is just a, perception matter. It's rather differentiated. For those with, stronger balance sheet, strong borrowers, I would say. Yes, in those cases, yes, absolutely, credit risk is not there. They are getting fundamentally stronger. But for those with weaker balance sheet, or maybe highly leveraged borrowers, yes, a little bit of risk, credit risk is, deteriorating. So for the investors, they have to, separate the genuine credit deterioration from the uncertainty-driven mindset. That is what I would like to say.
Thank you for that. Ms. Malhotra, what do you think? Is the risk really rising or are we overreacting?
Good evening, everyone. Your question is in two parts. So one is, are we overstating the uncertainty narrative? And the other part is the credit risk. So I'll go from my company's perspective and on a macro perspective. So from a macro perspective, I would say that the uncertainty is definitely increasing. It's definitely increasing, and it is, like Sir was talking about in the keynote address, so the uncertainty is there, and energy sector more so. So that part, we are all very clear, and it is there. But what impact it is having on the credit risk, I am not very sure whether it is actually increasing. And a banker is sitting on my side, our banker is sitting on my left side, and I wouldn't say that the credit risk on a company like GAIL or ONGC would really be increasing. Now, that is coming from the fact that what Sir was also talking about is the fundamentals of the banks and the corporates. And the fundamentals of the banks, like we talk about the NPAs coming down from, say, 9.5% to 2.5% in the last 5 years. The deleveraging of the companies in the last 4 years, because last 4 years have been, post-COVID, have been growth years. So a lot of companies had deleveraged. A company like GAIL has a debt equity of 0.26. So from that perspective, I wouldn't say the credit risk has increased. The uncertainties have increased, but the way the credit risk is looked at has increased. So traditionally, if SBI was to do a credit risk analysis of a company like GAIL, they would look at the debt equity, the cash flows and everything, the DSCRs. But I believe those numbers are not just from the balance sheet. The risk, when they are looking at the risk, is looking at the business risk in a more broader perspective. When they are looking at the geopolitical impact on a company like any company, and when we are talking about GAIL, I'm from GAIL, so I'll talk about that. So overall business risk is what they're talking about, and that impact of that business risk on our cash flows, and how resilient a company is, and what kind of internal safeguards they have to ensure that those business risks are taken care of. So I believe the credit, coming back to your question, yes, the uncertainties have increased. They are not overrated. They are there because since 2021, since COVID started, to the Russia-Ukraine war, to the Iran-US war, the impact is there. But the credit risk profile has changed. And it's not just the leverage numbers, but it is beyond that.
Okay, so what you're saying is the way we look at risk has changed, but the risk may not have gone up in a similar
Not
proportion.
significantly.
Right.
Yeah, because the companies are resilient. India, in a larger term, we have seen over the years that India has been resilient and taken care of. So how we manage that risk is more important.
Right. We'll come to that shortly. So let's move. Finally, let's try to understand what's happening with the last mile borrower through Ms. Singh of Satin.
So
If I talk about, so first of all, I'll just start by saying very humbled and I'm feeling grateful to be part of this panel. I'm सबसे छोटा panelist, whether it terms the organization or myself as a person. So thank you very much for having me here. And one another observation, you have made energy take the center stage, flanked by finance, and then rating is rating us all. So yeah. Now coming to your question of uncertainty. So I'll just quote Mr. Nagaraju here, uncertainty is here to stay. And I remember when I was studying and we would say these corporates having a dream run and we thought we will do the same. The moment I started my career, I saw Lehman. And it was glad because we were on the investing side, so we could get some good deals at that time. But now, challenges are very frequent. They are every year. In fact, we talk among ourselves that we want to have a boring day, a boring week. We want to have nothing to think about. That doesn't happen. Since my sector, my organization looks at the last mile, even more challenging. So we all know, even when we were coming out of COVID, and everyone is very gung-ho that the last few years have been very good. But shortly 2 years after we started coming out of COVID, our sector saw another crisis. So much so that it wiped everything off. And a sector which relies a lot on borrowing. So the credit cycle squeezed, the sector squeezed, and how it resulted was that 1 crore borrowers got out of formal credit system. Now we are talking about 1 crore families here. So where did they go? They all went back to money lenders, informal economy, we do not know. So that is the biggest setback in the world when we are talking about credit growth, economic growth. So many people were left out. The sector shrunk by 1 lakh crore. I know the numbers are very small when we talk about banks lending 40 crore every year. So while you see very good, very healthy balance sheet numbers, the net NPA is below 50 bips or even zero, sector like ours, actually because my entire sector is little over 3 lakh crore. 10% is the outstanding of what 1 year India lends. So these things, they don't get covered. They are not highlighted. But it impacts life because it's the last mile. It's where real India lives. So rural India is, through its activities, 70% people live there. They contribute 46% to the GDP. They only get 8% of the formal credit, which has further shrunk by 20%. So things are not the same. They have changed. And we see that in the form of people shying away from center meetings, because my sector is like center meetings, you meet the borrower twice a month. It sees in their queries on the top-up loans. JLG is not becoming as effective as they were in past. When I joined this sector, JLG was so effective. Even if some client's insurance claim was rejected, the other members would want to pitch in and fulfill for that. The sector had credit cost of 20 bips. And now the normalized numbers we are saying is 3%. So yes, change has happened. Organizations have adapted that in their risk models. And the sector has shrunk, but we are again saying green shoots. Of course, the SROs came in practice and there were new guardrails that formed. So over-leveraging, which Madam mentioned and even the other panelists mentioned, over-leveraging was cited as one issue why my sector went through a crisis. And that was, at that time, more than 20% borrower had more than 3 loans. Currently, that number is around 4 to 5%. Now, what will happen is the other people are just waiting for some loan to get over and then they may start applying for formal credit. They may be credit corrected, they may not be behavior corrected.
Right, we'll come to
Yeah.
over leveraging in a bit. But thank you very much for those qualitative and quantitative insights on the sector and the perspective from the rural India as well as the last mile borrower. So that sets up the stage quite well, very open. Now, let me further open that up through a discussion on how global shocks will travel into credit risk. So let me start with the lender's perspective again, Mr. Kumar. Geopolitical shocks are very easy to identify, but their consequences are not as easy to identify. So credit stress usually appears through second or even third order effects like inflation, higher funding costs, margin compression, or weaker demand, or even delayed receivables. So which second tier effects worry you most today from the credit perspective given the current global uncertain environment?
As of now, since the transmission has begun, let us say post-April, so we still to really understand the enormity of the risk that probably will flow through the system. But we are seeing, so if you look at how the country is holding on, how it is handling. So the ECGLS 5 was announced, then recently RBI and the government came up with some announcements too, overall giving a perspective that we are there to support, to handle. In terms of ECGLS 5, we are seeing a lot of MSME clients particularly approaching banks and seeking limits. Significant sanctions have happened. I would not be able to quote the number, but we are seeing, and it is quite widespread. While some sectors, food processing, for example, are comparatively higher. So wherever the energy consumption is more, those sectors are probably have a higher tendency to seek those facilities. Those where the energy consumption is lower, they are seeing lower limits. The challenge with the banks typically is this quarter also, typically the clients seek higher limits. They come for the working capital renewal, higher limits, all that. So not easy for us to differentiate between whether this, while since ECGLS has a guarantee component, etc., so whether they are trying to take that money as ECGLS or it is a normal working capital. On the ground, the risk seems to be contained. We have not seen the transmission in such a way wherein suppose a particular client is having higher raw material prices, they increase the product prices, and whether that product at that price has a demand absorption or not. We have not seen the absorption issue regarding the demand absorption. So as of now looks fine, but again the question is when the full transmission of the energy prices happens, how would it look like? Whether the pass through into the pricing of the product would, whether the market would be able to absorb, and if the market doesn't absorb, how it will impact. So maybe one more quarter probably we need to wait and see the full impact of this. But yes, the impact is there.
Okay, so you are a little bit cautious, but you are also in the same breath saying that liquidity is available to most of the borrowers and therefore they should be able to tide over the problem so long as it does not prolong too much. That's the
just to add, see, liquidity in the banking system is more than adequate. We haven't seen. The problem with the typical banker is that the pricing remains depressed because of the excess liquidity. So wherein the bond market pricing have been shooting a little above, but the pricing in the banking credit markets have been quite depressed. Liquidity has not been a challenge, and I think overall, yes, see, this current year's profit of the bank is quite high. So in terms of the availability of the credit, it's not an issue. Only thing is whether by absorbing that quantum of credit, the MSME particularly would be able to absorb the cost and pass it on to the product categories.
Okay, thank you for that. See, one of the biggest channels through which these second order effects get transmitted is the energy channel. And it's in fact one of the biggest transmission channels globally also for the global risk, the crude oil and gas market, energy markets in general. So Mr. Banerjee, ONGC has lived through oil at $20 to a barrel at one extreme and at oil at $140 at other extreme, and everything in between they have seen over the years. We also know that the treasury functions often see risks much before they show up in the financial statement. Now, what are the early indicators that you are monitoring today given this crisis?
Yeah, thank you. Yes, we navigated through different price regimes. Yes, you are right. During COVID period, it fallen to around $20 per barrel, and at some point of time, it was not 140. In fact, it touched 200 long back, but it touched 200. So we navigated different price regimes. So far as early warning indicators, which signals, you know, for impact in the balance sheet, of course, this needs to be identified before the actual things happen. Because once the impact is in the balance sheet, then everything is gone. You can't control them. The early warning indicators may be changes in geopolitical risk. Geopolitical risk is not only the conflict of different nations. It has its implication in sanctions, different sanctions like SDN of OFAC, US, then your FFT, then your United Nations sanctions, European sanction, UK sanction, even in India, RBI sanction. So we have to navigate through all these sanctions very careful because kind of untouchable. So being in treasury, we have to be very careful. Another indicators for geopolitical conflicts is supply chain disruptions. Hormuz we know. Earlier also Panama Canal drought and conflict. Suez Canal conflict. So all this had impact on our, treasury functions and balance sheet, of course. Apart from geopolitical risk, another is like commodity markets. Indicator like how your spot crude price behaving, how the forward curves looking like, shape of the forward curve, whether contagion or backwardness, it gives some indication how the price is going to move. Then your OPEC plus production indication, then inventory in major economies, demand indications, and big economics like India, China, and some other countries. This gives some sort of indication. So next, your global money market, like SOFR, US Treasury, and real interest rates. Then your liquidity, and Forex market also, like how the currency volatility, like say last 1 year, almost 9% depreciation was there in rupee dollar exchange rate. So that is one. Then dollar index, how it is behaving, your sovereign risk. So these are some of the indicators which of course we monitor. And there are many like inflation. During last 10 years, inflation was around, say, average 5% per annum, year-on-year basis. And the projection for next 10 years is around 4.5% for year-on-year basis. So these are some of the indicators we follow from treasury perspective and corporate finance side.
No, right. That's a very comprehensive list of all early warning indicators that one can monitor today.
Yeah.
So let me extend, ma'am, this same energy question to you from crude oil to gas. Gas was once viewed to be relatively a stable fuel and certainly more stable than oil. But in the recent years, this Russia-Ukraine conflict turned that entire assumptions around. So what lessons should Indian corporate learn from that experience, in your view?
With the increasing penetration of gas in the energy basket, the government's focus on gas as an energy alternative and gas being a transition fuel also. So the government wants the gas should be the share of gas in the overall energy basket to increase from 6% or 7% today to 15%. So gas, which was looked at, I mean, when we talked about energy sector, it was always talked about as crude and the change in the pricing of crude. But over the years, in the last few, I mean, at least 5 to 7 years, we have seen that gas price, and more specifically, we talk about LNG prices, which have become very, very volatile. And an impact in one part of the world, there is a ripple impact across the world. We have Russia-Ukraine war, the impact is seen. We have the Middle East war, Hormuz, we see the impact. The world at large and India specific, because today we are importing more than 50% of our LNG needs. So lessons, I mean, it's in public domain. So we had a long-term contract, GAIL had a long-term contract with GMTS, a Russian company, where we were importing LNG. And during the Russian-Ukraine war, and because of various sanctions and everything, so there was a default. Now, if there is a default in a long-term contract, which is possibly the safest form of energy security, so yes, there was a concern, and these impacts, and recently the Iran-US war, these impacts definitely have a huge learning for corporates like GAIL. And I would say that GAIL has been very resilient in all these years. But the main reason for that, and the learnings for us, plus what we have done, is that we need to have a very diversified portfolio of imports. And that diversification is not just on the geographical diversification, but also the indices. So when we have some crude-linked LNG, we have some HH-based, we have some JCC-based, we have some JKM-based, and the geographies are right from US, Middle East, Australia, and the portfolio players. So that reduces the impact of any geopolitical issues. Plus, another learning that we've had, and I believe all the corporates are now looking at, is bringing about these flexibilities into the contracts, especially where which has an impact, which have more geopolitical impact. And the energy sector, which we have seen the last so many years, so the contracts have to be more nimble to that effect, that you have these impacts. Yes, that will have an impact on the cost, because when we incorporate more flexibilities into the contract, that have impacts. But then that is kind of an insurance or a hedging to ensure that. And another thing, another learning that we've had is to include this risk, the risks that Mr. Banerjee was talking about, into our overall business planning. So the overall business planning of our company includes now, more than before, about the geopolitical risks and the wars, so to say. So yes, that is one of the biggest learnings that I would say GAIL had.
Thank you so much. So we just saw that shocks begin in the energy markets, and then they impact the corporate borrowers, large, medium, and small. Let me now bring the discussion down to households once again. Ms. Singh, when we talk about global uncertainty, we usually talk about oil prices and energy prices, trade tensions, or interest rates. But eventually, all that boils down to household level cash flows. So at the level of microfinance borrower in rural India, or even for that matter in the urban parts of India, we have a large number of MFI borrowers. How do these global developments actually show up in their livelihoods?
No, absolutely wonderful question. And I read somewhere that the oil shipments, they move at a very, very slow pace when they come. I think around 10 to 12 kilometers an hour. So that's why whenever there's a problem, the crisis reaches us with a lag. Same happens with our sector. Any crisis which hits the economy at large, the GDP numbers at large, hits us the last. Because the borrowers are doing very basic survival work. It is agri-related and everything. However, the challenges start coming in the terms of when there is increased freight prices, everything becomes expensive for them, including veggies and everything. While they grow most of it themselves, but there's many commodities which they have to purchase, hence their overall income which they is finally left at their hand remains limited, eventually leading a stress in their repayment behavior. Also, another challenge that comes is two-pronged. One is our own boys who are roaming on motorcycles. So we have actually seen rationing of fuel in many stations in deep within India, leading to disruption in the operations. And for our clients, it's about also the fertilizers. That is challenge again, which comes with a lag. So this is what it causes is, for us on the liability side, we see hedge cost going way up. Like he mentioned SOFR, Mr. Banerjee mentioned SOFR, but hedge costs are also now north of 4%. And now RBI is bringing in measures to bring in option to take 1.5%, which I was reading in the papers. So those are the warning systems for organizations like us, because unlike everywhere when foreign borrowing is maybe 3 to 4%, for us it is 20%. Maybe because our sector attracts a lot of sustainable financing or impact capital. That becomes expensive. So for an organization, operating becomes expensive. For our clients, the signals are missed center meetings. The signals are loan becoming more fungible. So the income generating loans start becoming consumption loans. And that starts, and the field officers are the first to know it. It gets captured in our data with a lag, which gets captured in PAR numbers with a lag, and the PAR 1 data. So the one EMI being missed starts shooting up. If you look at our ECL models over the time, our LGD has started increasing, the loss given default. Because earlier, whatever happened, one EMI loss was not even considered anything. Last 2 years, if a person misses one EMI, there's 80% chance they will become an NPA. So I think these are some of the signals, if I may.
Thank you so much. These are very critical inputs that you have given us. Let me now quickly change tracks and let me be a bit more specific and focus on energy prices and inflation and their impact on sectoral stress. So, Mr. Banerjee, oil markets have become as much geopolitical instruments as much they have been the economic commodities. Yeah. Higher oil prices can benefit some parts of the value chain, but we also know that they can create stresses elsewhere. How do you view these credit implications of elevated oil prices across upstream, midstream, and downstream businesses?
Yeah, the effect, the credit impact is not same across the value chain. First, let's talk about the upstream. I belong to upstream. So yes, for higher oil prices, upstream, higher profit, higher revenue, higher profit. It translates to higher revenue, higher profit, better cash flows. So your credit profile increases, credit quality increases. So, but yes, it is not universally true because when the prices goes up, commodity prices goes up, the cost of the oil field services also goes up, and your cost goes up naturally. It moves in tandem with the market. So, and there is at that time there is a tendency also to spend high. So it depends on all these factors, like how you manage your spend. So, but in general, the bottom line, yes, from credit perspective, higher oil price benefits the upstream and improve the credit quality. Coming to midstream primarily refers to storage, transportation, pipeline, a bit of infrastructure also. I would say it's a bit neutral. The impact is neutral in the sense that the revenue or the cash flows are not directly linked to your commodity price. Here, the revenue or the cash flows are linked to your contracted price, like the contracted price, contracted volume. I said midstream means infrastructure, your even refinery throughputs. So it's more of neutral, credit neutral. Downstream, bit complex. When you come to downstream, yes, higher crude price means higher input cost for the downstream. And higher input cost puts a pressure on your balance sheet, your working capital, there is a pressure, your margins get squeezed. So, considering all these, downstream have a impact on in a higher price regime. There is a pressure on the downstream. But then, from credit perspective, it's not the price, how much price or at what price you are sustaining. It is the companies which generate sustainable cash flows in all price regimes. They actually survive in the long run. So ONGC thrived, ONGC in fact navigated, I said, different price regime. And we thrived from $20 to $200 per barrel. So that is, nutshell, I would like to say.
Yeah, thank you, Mr. Banerjee. From crude oil, let's move on to gas and LNG. While the user industries may be different, ma'am, but the credit implications can be equally important, and that's what we are trying to look at here. So if the energy prices remain elevated or supply chains remain disrupted for a longer period of time, which consumers do you think will be more exposed in the current environment?
Like Mr. Banerjee was saying, yes, with the increase in the energy price, all these sectors get impacted, but more so, the impact would be more on the downstream and the customers. From a gas perspective, if I talk about, hitherto we were talking always about crude. When we talked about inflation, when we talked about macroeconomics and energy, we talked about crude. But over the years, we have seen that the price risk or the impact of energy on the inflation is different. And the price risk is become more encompassing. It is not just the crude. Earlier, it was just that OPEC would meet, they would have a discussion, and they are increasing or decreasing the production, and the crude prices would vary. But today, I believe gas and crude, both, have become very important and have a very major impact. And that price or the impact is not just on that part. It is more to do with the logistics, which route they are following. And that impact, I believe, has more impact on the downstream customers and common customers. Today, the CGD sector and the recent impact, the dispensation which the government is giving as far as the PNG, CNG, and the small customers are concerned. So there, they are actually feeling the impact of higher prices of both gas and crude energy price. Mr. Nagaraju was talking about the fertilizer sector. So today, when we are talking about the impact that it is having on the government, so when we are procuring gas for the fertilizer sector, today it is coming at which was earlier coming at $11, is now coming at $19. So that is the impact, and if that is not passed on to the agriculture sector or the farmers, ultimately it is the government which is bearing it. So the inflationary trends of energy are much higher today. It is how you manage that is the choice that we have to make.
That's right. But I'm not going to give that liberty to you, Mr. Sharma, to say that how you manage is important. What I want to specifically ask you is if all of them had similar balance sheets and similar liquidity, let's say they are all resilient, they have similar liquidity, and if these prices persist for a little longer, where will you see cracks surfacing earliest?
Let me first share the positives. Some sectors is really surprised. EPC, looking at the opportunities, cat would get, so they can build on. We also see a lot of uptake in the defense-related industries. We see uptake in the electronics. So some of these sectors getting positives as well. So it's a combination of the energy plus vestige, not energy alone. In terms of the one more CGD players are doing pretty well. Maybe consumers are feeling the heat, but the companies are doing well. Downside is huge. It's not small, and I think we all agree that when the transmission gets completed to whatever sectors government desires, fertilizer and probably would not be there, but many sectors would start feeling the heat, and then we need to really understand how do we handle it. So still to see one more sector, the EV sectors, whether the passenger category or the trucks and buses, there also there is uptick. So these are some of the sectors where the uptick is there, but my side is downside is stronger. We need to wait and watch to see that how does it unfold and the quantum it unfolds.
Thank you for that. Ms. Singh, just a quick response from you as well, and very pointed, which is if this situation persists a little longer, how quickly do you think this will translate into any repayment stress at the household levels?
So two factors, which is the fuel prices and the fertilizer, which will impact the agriculture sector, is how the impact will come. But so far we haven't seen the crack. And I think another quarter is important for us to watch if it really comes, because so far it hasn't permeated to that extent. There is more paranoia than real things that are happening. Otherwise, it will, yes, definitely become the cash at hand of the end customer will be suffering, and that's all that is there to be watched. Can't be more precise and pointed.
No, thank you so much. Moving on then from to resilience, liquidity, underwriting practices. We have looked at likely uncertainties. Let's move on to what we should be careful about. Mr. Sharma, lenders are changing standards or risk appetite because of geopolitical uncertainties and external spillovers. Or is it the current balance sheet strength that is giving banks the comfort currently? Are you comforted by the balance sheets, or are the lenders also looking at changing their underwriting standards and taking a relook at their risk appetite?
See, underwriting is a large word. When you set up your models, you look at holistically, you look at ऐसा मॉडल जो बरसात गर्मी सर्दी सभी में काम करेगा, not a model which works only when there is a good time, there is a bad time. And the models are dynamic, so they keep learning as we keep learning. So it always, there's a continuous evolution of the model. So I would not say that just because there's a crisis, we tighten the belt and do not lend. The numbers you have seen, that 16% growth. And even now, if you look at the April-May numbers, we are seeing good credit offtake. These sectors which I mentioned just now, we are seeing good demand from them. So we haven't seen a slowdown as yet in terms of sectors or in terms of our ability not to support them, because the biggest advantage as a country here is that we are dependent upon domestic consumption to a huge extent. That cushions us from the other vagaries. So to my mind, underwriting standards would continue to learn, but there's no tightening or loosening, if I use that word. And the banks are happy to do the business which they are in, business of lending.
On that very optimistic note, let me move on to Mr. Banerjee. Whenever corporates are faced with any uncertainties, the first reaction is to build up some liquidity buffers, because at the end of the day, that's what helps you tide over the difficult situation. And that is exactly what RBI also seems to have done by announcing ECLGS scheme where 2.25 lakh crore of liquidity can come into the market. But coming to you, according to you, what is the ideal liquidity buffer a large corporate like yours should be looking at? And related to that, if you can give some advice to the audience at large on how to manage liquidity and what kind of liquidity they should maintain during uncertain times.
Yes. let me be candid, there is absolutely no ideal number for liquidity buffer. Absolutely no. It depends on the company's business model, its access to capital, how fast and how easy it can access to capital market. It depends on its cash flow volatility, again, which is from the nature of the company's business. And there are many other factors which actually determines the kind of liquidity we should maintain. Three things I would say to the corporates or the treasurer who handle. Keep yourself prepared for three things. One is adequate liquidity. Again, I say adequate means liquidity cannot be a single number. So liquidity. Second one is resilience. I mean, how you withstand the shocks. And third is agility. How fast you recover from the shocks. So these are the three things I would suggest to the audience, particularly those in the treasury. So rather than predicting the future shocks, I would say prepare yourself to manage the shocks. So these three things: liquidity, resilience, agility. So coming back to my question again, this question again, there is no magic liquidity number, but to the company's senior officers who definitely tries to enhance their return by investing money, my advice would be, yes, maintain a certain quantity, a certain amount of fund in liquid form. Yes, it may look unproductive during calm period, but during stress, during crisis, this liquidity is invaluable.
Right.
Okay, thank you.
Yeah, we are rapidly running out of time. So let me just, come in here and then ask one common question to all of you, your final thoughts, each one of you. It's become quite clear during the discussion also that, which supports the widely held view that India can withstand global turbulence because of strong domestic demand, strong economic growth. And to what extent do each one of you agree with this view? Is if you can throw light on, that is one. Second is one risk which market is underestimating, if you can, in your view, if you can touch upon that, and one opportunity that the market may be overlooking, if you can highlight that as well. We can start with Ms. Singh from the ground up, the last mile borrower perspective.
So I would first talk about the opportunity. I think there is immense growth demand. India is a young nation, and with an average age of 27, and the kind of activities our sector people are involved in, we see a lot of upside because all the domestic demand actually starts being catered from there. So that's the opportunity. Risk, of course, remains credit, but more than that, the climate risk also is something that is impacting us. Eventually giving the whole credit, I'll say, some gray clouds. But looking at how the government has pumped in liquidity, how the sector has come out, we see that also petering out. So yeah, that's my 2 cents.
Thanks. Ms. Malhotra, what is your take on the same?
I believe that with every risk there comes an opportunity. And the risks that we have seen over the last 4 or 5 years, as far as the energy sector is concerned, yes, there have been disruptions. Yes, there have been thoughts, but the opportunities that have come are, look at the agility with the upstream companies. Oil India, they recently found the gas in Andamans. So that kind of an urgency is sort of coming in India, and that urgency is ensuring a rapid change Look at the change in which the renewables are coming in. Look at how we are talking about nuclear power. Look at how we are talking about CBG. So all that in the energy sector, it is becoming so fast. We are becoming more I mean, this whole, right from COVID has taught us that we need to look inwards. We have to be global, but we have to look inwards. So for that, I believe huge opportunity for in the energy sector, and the government is doing its bit. And we, as in the public sectors, are also doing that, and we are looking inwards, and huge investments are coming into it in the energy sector. So I think there is a huge opportunity in this, amid this chaos.
Right. Mr. Banerjee, your perspective from the Treasury side?
Yeah, not as a treasury, as your question is, in fact, in general, I fully concur with the views of Mr. Singh, Ms. Singh and Ms. Malhotra. Apart from that, as a country as a whole, I think we are in a well position, better position as compared to many other countries. Our huge domestic demand, big manufacturing base, digital infrastructure, strong credit cycles, all these cater to make India more resilient. One opportunity, yes, one of the things which the opportunity which has been overlooked, that many times we say that like geopolitics and disruption is going on. A major growth of demand, India's consumer demand, is from India, a domestic market. So a little bit of, and also a little bit, diversification of our supply chain management. So, not supply chain, I would say supply chain, not management. So, from that perspective, India is a bit insulated from the risks. This is one plus point. But then this insulation. Insulation should not be confused with immunity. As India is integrated, this part I am saying the flip side, integrated with the world. Any flu in in any economy of the other part of the world definitely has an adverse impact on India. So the question is whether we are getting impacted by all these factors. The moot question is how resilient we are as a country, how much we can absorb the shocks in terms of crisis. So from that perspective, I would say, yes, India is much better positioned than many other countries in the world. So that is my take on that.
Okay. Mr. Sharma, your views?
So in terms of opportunity, the entrepreneurial mindset of the India is the biggest advantage we have. I keep meeting a lot of friends across the country. छोटा काम करते हैं and do it so wonderfully. I will not call it risk. The weakness I see is we are not aiming to be professionally, globally the best. There sometimes we lack. So whether our product profile or whatever we do, is it globally the best? The answer is still not 100% true. I think if we can improve in that direction, then see, I was just meeting someone today. One item which was costing 2 lakhs, वो 500 में बना रहा है. You just imagine the scale. So innovativeness. So brain is there. Only thing is if someone understands, maybe slowly now we are seeing the young minds are getting exposed to the global scale, what is happening globally, and from there they are learning. They should not stop at some middle ground. They must try for more. So I think this entrepreneurial mindset coupled with the desire to be the globally the best would take us to the new heights. That's what I would like to conclude.
Thank you. Thank you all the panelists. Do we have time for a couple of questions? If not, then I'll just quickly sum up. Thank you. This has been very enriching discussion. So India may be entering this period of uncertainty from a position of relative strength is what we saw. But the credit risk is becoming more complex. It's not as simple as it used to be maybe pre-COVID. More interconnectedness, uh, less visible in conventional financial statements. We heard that the global shocks do not move in a straight line. They may show up first in oil and gas and LNG prices, and then you have second order effect which may travel down to inflation, funding costs, margins, demand, and eventually liquidity. And also, I mean, the same impact of the same can also travel down all the way to household cash flows and the borrower behavior, as we saw in case of Satin. The larger lesson for us is that the credit assessment cannot remain purely backward looking. Historical financial statements are really important, but resilience, adaptability, which is what the panel talked about, liquidity, supply chain strength, and ability to absorb shocks are becoming very, very important going forward. On that note, let me thank all the distinguished panelists for their insights. And thank you, audience, for joining us and make this evening lively. Thank you very much.
Many thanks to our distinguished panelists for sharing their valuable perspectives this evening. Now I request Mr. Bajaj, our Managing Director, and Mr. Shubham Jain, our Group CEO, to come on stage and felicitate our respected panelists. Ms. Aditi Singh. Mr. Anirudh Banerjee. Ms. Nalini Malhotra. Mr. Ashok Sharma.
Thank you, Rohit.
As we conclude today's formal proceedings, I would like to call upon the stage Mr. Suyash Asthana, Executive Director of Business Development, to deliver vote of thanks.
Yeah, good evening, everyone. Darwin's theory has always proved correct, survival of the fittest. And in this present scenario of change and uncertainty, absolutely correct. The guys who will improve their skill sets and do the renovations and various steps, they will survive and they will reach to the heights. So as we wrap up to this wonderful evening, it's my privilege to deliver the vote of thanks on behalf of Infomerics Ratings. First and foremost, I sincerely thank to our keynote speaker, Mr. M. Nagaraju, former Secretary, Department of Financial Services, Ministry of Finance, in absentia, for taking time out his busy schedule to join us and sharing his thoughts and insightful remarks. His presence has set the perfect tone for the evening. My sincere thanks to all the distinguished panelists, Mr. Ashok Sharma, Ms. Nalini Malhotra, Mr. Aniruddha Banerjee, Ms. Aditi Singh, and our moderator, Mr. Rohit Inamdar, who have spared their time and shared their valuable thoughts and insights on the very pertinent topic of the day, navigating the credit cycle amid the global uncertainty. A special thanks to Mr. Ashok Sharma and Mr. Rohit Inamdar for traveling from Mumbai. I also thank Mr. Vipin Jindal, Director Ratings, for making the insight presentation about credit trends in the key domestic sectors and its way forward. Finally, heartiest thanks to you all, our esteemed guests, banking leaders, our clients, and industry experts, for coming all the way on the weekday, making IVR Connect 2026 a great success. The overwhelming response and the gracious presence of you all has made us more motivated. Without the participation of you all, this could not have been possible at all. Now I request you all for joining the networking dinner. Thank you very much, and dinner is certain.